Smith and Wesson is a company which is very interesting. It is a weapons manufacturer that only basically sells to consumers. It's also a fairly small company, not even $500 million right now. Plus, it's a very volatile stock. From $30 to $16 to $5, we all saw that in the last 5 years. It pays a nice dividend yield and has been buying back shares for a long time now. So, is this stock a buy? First, we need to understand it. What kind of stock is Smith and Wesson? They basically make their money in two ways: handguns and long guns. They also have some other products and services, which is a small part, but most of their money comes from the handguns. That's what they're also kind of known for. I mean, when you think of Smith and Wesson, I think you think of their revolvers. Issue is, you don't buy a handgun every month. Not even as an American. So their revenue is highly volatile. When we go to quarterly, you can really see how it kind of bounces around. They were growing until 2016, but since then it has kind of plateaued out. Sometimes they have really good quarters. You kind of benefit. If people are going to be worried that there's going to be some kind of conflict in America, they're going to buy handguns, rifles. And this is where Smith and Wesson benefits. Currently, Smith and Wesson is not making a lot of money. We can also see this from their units shipped. Year over year, they're still down 4% for handguns, 10% for long guns. And that also creates highly volatile net income. During the pandemic, a lot of people bought guns. Smith & Wesson made $300 million over the last 12 months there. Basically the entire market cap in one go. But then there are times where people do not buy a lot of guns. Then they make only 16 million. Right now, it's kind of in between. We're at 30 million. That's a characteristic I don't like about businesses. Most businesses, I want to have at least some kind of reoccurring revenue. Maybe you would think, hey, Smith & Wesson, don't they sell ammunition? Well, no, they sold off that business a long time ago because it's not really profitable. When you look at inflation keeping up, this is just some examples of firearms, but it kind of shows you that mostly guns kept up with inflation or outpaced it. But ammunition prices have collapsed because production has gotten way more advanced of them, and while as an owner you would say, hey, ammunition is still expensive, you don't know to make a lot of money on ammunition as a manufacturer. So Smith & Wesson sold that business off a long time ago. And I think it's a mistake to look at Smith & Wesson and to say, hey, historically they have grown until 2017 fairly fast, and now they're just kind of at a low point. Maybe in a few years they're gonna go back to growth mode. Well, no. Smith & Wesson before was a different kind of business. We can see this from their share count. They have heavily issued shares to do acquisitions until 2013. We can see they did multiple $100 million acquisitions until 2017. So that is where a lot of this growth came from. But now they haven't done any acquisitions and it has kind of plateaued out. Plus their margins have normalized again. One, you could say, hey, we're currently at a low part of a cycle. Not a lot of people are currently buying handguns, but more people are gonna buy handguns. Maybe times are gonna get worse. Currently, with Donald Trump as a president, I don't really see a lot of people buying a lot of guns. There's a reason for this. Gun owners often buy guns more when they think they're not going to be able to buy them in the future. For example, after a school shooting, gun sales usually spike because people say more regulation is going to come in with guns, let me buy the gun now while I still can. If Donald Trump is president, while he has restricted the Second Amendment before, people don't really see him as an anti-gun guy. So I don't really see a lot of people rushing out to buy handguns right now. And I think all this is also where the market agrees because we're kind of at a low point. Now you could say, hey, the 4P is 23. The market really doesn't value this business very cheaply, you must say. Yes, but this is cyclical. If it recovers to 100 million, which we had for multiple years here, 2016 for example, then that is only a less than 5 PE. We're currently at the low part of a cycle, and maybe this is a good time to buy. Of course, we have to question, what could break the cycle? Regulation. And I think here Smith & Wesson has an advantage. Handguns are way less likely to be targeted by gun laws. They're more gunly focused on assault rifles, etc. While they have rifles, they're more focused on handguns. Plus, they don't really have a lot of debt right now. They have issued some debt lately because they're still doing a lot of buybacks. And cash flow is very low right now. We can see they're paying 22 million dividends, did 23 million buybacks. They had to take on debt to finance this. And when you look at 133 million long-term debt, a lot of this is leases, so not even like true debt in my opinion. You have 39 million cash on hand. This company is not at risk of going bankrupt. They don't have a lot of goodwill, only 21 million. They did a lot of acquisitions which they had to write down. So we had 8 book value per share. We're nearly trading at book value. When times are bad, they dilute you a little bit, maybe 1 to 2%. When times are great, they buy back huge amount of shares because of enormous free cash flow. I would say around 3% share buybacks on average. You get the nice dividend of 5% right now. And I don't really see this as a risk of being cut. Unless operating cash flow stays down, then they might cut the dividend. or decrease the share buybacks. Smith and Wesson comes out of an investment phase. They invested a lot of money into production. So I think once these shipments go up again, there's a good chance this is gonna give a lot of money. Now, what would I pay for the stock right now? For that, I would look at normalized free cash flow. We can see over the cycles, normally maybe around 100 million. In low times, around 40 million. Let's go with 75 million in free cash flow. So when we look at the valuation, if we give them 75 million free cash flow on average over the cycles, then we come to currently 1.66 in free cash flow per share. I'm going to assume they pay out 33% of cash flow as dividends over time, with a little deduction due to taxes. I'm gonna assume they're gonna buy back around 3 to 4% of shares. The gun market is not greatly growing. Maybe they're gonna bring out a product here and there, which is gonna be a hit. It's gonna be a very slow growing market. I think it's gonna grow in line with inflation. 3% depends. 3% share buybacks, 3% growth, slight deceleration after 5 years, 10 multiple. Cyclical stocks, which are very heavily dependent on individual purchases, do not get high multiples. While I think it's a great company, there could always go something wrong there, especially in the gun market, especially with a company this small. But even then, $14 per share. Currently 10.7, that's a 34% upside at a 10% return. Not at all bad. But you always gotta remember, we're currently assuming that over the time, they're gonna get 75 million for cash flow per share. What if the average is gonna stay lower? Maybe it's gonna be 50 million. Then we stand at 1.11. And then we're already not getting a 10% return. This is very heavily dependent on the return to the average. This is harder to say with the gun market than with other cyclical companies, like maybe mining companies. I can say iron ore prices are unlikely gonna be collapsed for eternity. But gun prices in the US might happen, but they're gonna stay very low for a very long time. And then you don't get these share buybacks, then you don't get this dividend. But let's just assume it was 75 million for now. If it goes better, we return to a growing gun market, more people are buying guns, you're willing to spend more on them. 8% and 6%. 30 multiple, not that much higher. You can see these are not huge improvements. These are just slight improvements. Then we already have a double. If a stock doubles, we would still get a 10% return. Now what if it goes worse? We still get to the 75 million, but we only basically get buybacks over the next 10 years. And a 7 multiple because, you know, a company which is not growing, very small market, 7 multiple. In that case, $9 per share. And that is not a huge drawback from today's prices, so I do not really feel like Smith and Wesson is a risky purchase right now. The downside is not very high. You have a risk that we don't return to these averages. And then either the dividend or the buybacks have to be cut. And while it would still be nice to have this 4.85% dividend during the time, it is not great. That would not be a great return. One benefit Smith and Wesson has, the small market cap, 470 million. This is easily an acquisition target for some companies. If someone wants to get their foot into consumer weapons, 470 million, they could pay maybe 1 billion, 2 times market cap would instantly probably get accepted by the board. You would have a quick return there. I'm not playing on that, but I'm just saying it's a nice target for that. I think it is not a bad position to have right now. But while the risks are not very high, the reward is not that great for me right now. And I think they're just better buys, which have a better business model. But overall, I think there's always a risk this shoots out. The gun market can quickly turn around, and their net income of 36 million can instantly go to 100 million. I promise you, the stock will not be trading at an under 5 PE. What do you think about it? Write down below. Have a good day.